So here for each of this, see at the entry level itself, you can see the entry description. The supplier is CLP. This is another invoice. Okay. And supplier site and the invoice. Okay. So these are individual transactions. So no matter what transaction you have on that particular, as per your need, you will have this. Okay. So nothing is incomplete, invalid. This is one which is invalid. Invoice validated. So it tells you about the event class, the event type, all of this information is visible on this. So this is at the sub ledger level, the XLA tables. Okay, the sub ledger XLA tables. Okay, so do have a go at it. I will also see, if why there's recording has not been enabled. Probably you'll get it today. So once you get it, you can go ahead and try it out. Okay. So any questions from Rakesh or Amit?
No, sir.
All right. So the next topic we'll be going into is the intercompany accounting. Okay. On the GL side. Okay. So basically, when it comes to intercompany accounting, we talk about examples of transactions between different entities. So if you look at this particular example here, let's say there is a vision shared services. Okay, the shared service is the procurement shared service which buys items for different entities. So here in this particular example, there are two entities. One is Vision China, one is Vision US. So Vision China is paying for $1,000 worth of expenses. Vision US is paying for $800 worth of expenses. So the Vision shared services puts an order out for $1,800. As you know, bulk purchases fetch you better price. So companies often pull in all their requirements and put a bulk order, right? So that they are able to better leverage the entire procurement process. In a sense, behind the scene, the intercompany accounting that will happen is Vision says shared services, there'll be a transaction between Vision shared services and Vision China, which will ensure that this entire transaction is balanced out. So this is the intercompany receivables transactions, payables transactions, or between Vision shared services and Vision US. These are the transactions. Okay. So intercompany, through this intercompany accounting, what you're enabling is you're enabling cross company accounting.
So, for example, it's something like an on-site offshore also, right? Accounting.
Yes.
If an Oracle incorporation, Oracle India, if they want to,
Correct. Correct.
okay.
Exactly. Cross charges,
Yes.
then they do a lot of this. Actually, most of these are, where you have either revenue sharing or repatriation of profits, or
Or even the funds
expenses.
coming from the on-site.
Yes, those expenses also. Okay, so behind the scene, what the system does is it will generate the intercompany entries. Once your things are defined properly. So what aspects of intercompany do we enable? One is intercompany balancing. So the transactions between the legal entities, they have to balance out. If you look at here, within this 1800 and 1800, you have this corresponding entries getting balanced. Intercompany transactions, you can do manual transaction creation through the different transaction screens or spreadsheets. Manually, you can always do. System also does this automatically based on your setup. Intercompany reconciliation, there are reports that help you to do the comparison of the payables and the receivables accounts. Now, intercompany balancing will allow automatic journal creations based on the intercompany setup that we have established in the system. You can have more than one balancing segment in the system. Okay, and you can generate the intercompany accounts for cross ledger allocation from one ledger to another ledger. Also, you can do the cross ledger allocation. So,
Saurabh, what is balancing segment in
sorry.
a sense? What do you mean by balancing segment?
Balancing segment means, as we know in journals, the concept is journals have to be balanced, right? So debit and credit has to be equal. Now, at
Correct.
what level will the total of the journal and total of the debit and total of the credit be equal? For example, it can't be at the account level because each account there'll be a debit, there'll be a credit in another account. Account information will be different. But at the company level, so let's say the company you have a debit and a credit. So company debit and the company credit. So then there'll be a balancing. Okay. For example, if you look at this, there is a balance between the debit and the credit. Okay. Just give me a minute. I just need to answer this phone. Just 1 minute. Huh? Yeah. So basically, the so coming back to the balancing. So balancing means at the company level, your debit and credit is tallying up, right? So that is the balancing segment that is defined in the system. Okay.
So,
So
Eric,
yeah,
a chat field or something will be created, or how it will be created?
it will be when we are defining the structures,
Yes.
uh, key flex field, there has to be a qualifier that we identify, which is the intercompany balancing segment, or there'll be a balancing segment. You can have a primary and a secondary balancing. So based on that, usually the company is the balancing segment in most cases. Okay. And so what happens at the company level, all your balances, all your journals have the debit and credit has to be equal. Okay. Hello.
Yes, sir. Yeah, got
Yes,
it.
sir.
Okay. So at the balancing level, the journal entries are created. The the general ledger journals are also posted. Okay. Whenever a journal entry is posted, it will generate the balancing automatic, the intercompany balancing, it will get automatically generated based on the journals that are posted. It will allow three segments. Okay, it will allow three segments for the every chart of account. So you have a primary, the secondary, and the third balancing segment that you can define. You can use a single or a cross ledger for allocation journals. Cross ledger is from one ledger to another ledger. You can have intercompany allocation journals. You can also allow or identify intercompany partners if intercompany is enabled. So intercompany partners are people who are serving more than one entity. Okay, somebody serving Oracle US and Oracle India. Okay, or your organization working in two different geographies and you have a supplier or a customer who operates in both the geographies. Rules for the intercompany you can define at the ledger, chart of accounts, legal entity, and at the primary segment level. You can use a combination of the journal source and the journal category for defining your journals. You can provide a clearing company option for handling journals. Clearing company concept would be whenever, like this, in this particular case, we had that the shared services, right? So all transactions are done under the shared service against the shared services, and then the corresponding transaction between the shared services and the respective units. All right. So intercompany balancing will be done automatically in all these 8 cases. When the subledger, I'll repeat this one more time. When the subledger journal entries are created, when the general ledger journals are posted, and it will allow up to 3 segments per chart of accounts. We can use single or cross ledger journals for allocation journals. It will allow or identify intercompany partners if intercompany is enabled. You can have rules defined at the ledger, chart of accounts, legal entity, primary segment levels. And you can use combination of journal sources and journal categories for providing clearing company options for handling journals. Okay, so clearing company was something like the shared services. So you do the transaction against the shared service and from the shared service to the other journal. Okay, as part of the setup, we will be enabling the intercompany account at the ledger setup stage. Okay, when we define the ledger options, there is a small checkbox, enable intercompany accounting. That is where we define enable the intercompany if required. Not all companies require intercompany accounting, but in case it is required, then you can enable it at the ledger level. Then you have to define and manage the intercompany balancing rules. What are the different rules that apply for intercompany? Then you manage the secondary and the clearing balancing options. What are your balancing, which are the balancing segments? So there is a sort of a hierarchy that applies for the balancing rules. Okay, so there is an order of precedence. For example, if no primary balancing segment rules are defined, then it will look at the legal entity rules. We said, if I go back here, we said rules can be defined at ledger, chart of accounts, legal entity, and primary segment levels, right? 4 levels. So depending on at what level it is defined, it will check. If primary segment balancing rules are defined, it will pick that up. If it is not defined, it will look at the legal entity rules. If legal entity rules exist, it will take it. If no legal entity rules exist, then it will look at the ledger rules. Do we have any intercompany rules defined at the ledger level? If no ledger rules exist, then it will look at the chart of account. Okay. If the chart of account rules, basically that's your lowest level. So there is sort of a precedence order through which system will run through. Okay. We said intercompany rules can be defined at the source and the category levels also. So it will look at the combination of source and category to define the intercompany balancing journal. So it will look at both the journal source and the category. Now we know in the source and the category, for example, in the source, we used to give payables, we have receivables, we have adjustment. These are typically, category. What is the category of the journal, right? So there is a value for others as well. So it will look at, first, it will look at the journal source and category. Okay. Then it will look at the journal source, whatever may be the journal source, and category, and the category of others. That is the second option it will look at. Third option it will look at is the source of others. So the journal source becomes others and any other journal category. And the final level it will look at is both are others. Journal source is others, journal category is others. Okay. So these are different rules that we define to set up the transactions. So let's now take a look in the system and see what we have, whatever we talked about. So if we go to the ledger options, see there is a section which says enable intercompany accounting. If it is enabled, then those automatic intercompany journals will be created. Okay. If it is not enabled, then it has to be, the intercompany journals have to be done manually. Okay. So this is the first of the setups that you need to enable, based on which system will show you, will generate the accounting for you. Now, if you come here and we type intercompany, you will get all the different places where you can define the intercompany rules. Okay. So these are the intercompany system options. So when we go into the system options, here, see, this is exclusively intercompany related setups. Okay. It talks about what is the intercompany currency, what is the minimum transaction amount, what is the minimum entered currency, conversion rate, whether the receiver can reject the transactions or not, intercompany calendar, default transaction type, summarize the distributions for receivables invoicing. So all these are the intercompany related ones. Then you have a intercompany period status, intercompany organizations. Okay. So as you can see, these are the different rules that you can define in the system. Now, intercompany transaction types. So it tells you, you know, what are the different transaction names that will appear. Okay. This, these are the, usually these are all intercompany related at the receivables level. Okay, transaction types are used at the receivables, in receivables. So these are more applicable in case of receivables. Uh, these are the receivables related assignments. So any particular business unit that you will be using, let's say US. and the corresponding transaction type, let's say adjustment or things like that. So you are linking it there's anything with the corresponding receivable related transactions. Okay, let's just if we just open that create one, it's a short screen so we can see that better. So as you can see here, you have the business unit and the corresponding receivables transaction type. Okay, in the receivables we'll see, after this, when we define receivables, we will be reviewing the different transaction types, invoices, debit memos. So over there is a intercompany transaction type also. So you are linking these two so that whenever intercompany transactions are raised in receivables, the corresponding transaction type for intercompany will be used up over here. Okay, so this is the linkage between the two. Next is these are the intercompany balancing rules. So we had said that the balancing rules can be defined at multiple levels. Okay, so primary segment rules, legal entity rules, ledger rules, and the chart of account rules. Okay, so you could have a from to, saying from one ledger to another ledger, or you could have a specific chart of accounts that you want to use. So let's say we want to see US. So for particular ledger, you could have a specific ledger rules. Okay, you could have from to, depending on how it has been set up, or you could have it for a particular chart of accounts. So let's say see here, there is a rule that has been specified. So chart of accounts is this. This is the receivables account. This could be the intercompany receivables account. This is the intercompany payables account. And what is the source? So in this particular source, it will look for, it's not specific to any source. And in this particular case, it will look for others. So this, when the source category, when the source value is other and the category value is other, then the accounting will go into these two cases.
But what happens in case of none?
So even see, in this particular case, they have set up the same account. So you could optionally have it in different accounts also. So similarly, you could have a rule for ledger. This was for chart of accounts. So you could have a mapping from to ledger. So you could say, let's say US to, I don't know if it is there or not, or UK. Let's say from UK. US one legal entity. There's nothing defined in these cases. So searching only, we got one value here actually. So nothing else. I think if we do a transaction, that will become easier. So let's take a look at how we set up a rule based on which we can define a so we'll define a source rule. Okay, so for this particular one, if you let's reset this. Okay, so everything's gone, we have a clean one. So now we will go to the we'll create a new rule. Okay, where in the primary balancing segment we are specifying if the source is others and the category is also others, Transaction types, you have different transaction types. Here it will be none. So for the primary segment balancing rules, we are looking
I think there are some fields you need to scroll right.
from ledger. Yes. From ledger, we'll have the ledger to be specified. We'll specify the US ledger. Oh, it exited out of that. So the source is again others. Okay. Then we have the category of others. Okay. The transaction type is none. From ledger is the US primary ledger.
The balancing rules can be within the ledgers also, right?
Sorry, one more time.
The balancing rules, what we define, can be within the ledger also, right?
Correct. Correct.
So in this case, both from to can be same.
Yes. That's exactly what will do. So we'll set this to the within this, and from legal entity we have the US one legal entity. Since it is related to only one legal entity, we'll leave it like that. And from balancing value, what is the balancing segment value? So which is 101. Okay, so we can just all others is there. Okay, so it will go to receivables account. This is the specific receivables account against which the intercompany will be set up. So we have 10110, then we have 1 2. Okay. There should be one for intercompany. We have for receivables usually, if there's an intercompany setup, let me look for that. Um, so you have the intercompany receivables. we have a payables also for the payable take care of the payables related income intercompany account. And once this is done, start date, have it as early as you need as per your requirement. So let's say we have it from first. Okay, so the rules are now saved. Okay, so this is the one that we have just now set up. Okay, and so this is how you can define your rules. Now we'll be entering these journals and they go for approval. In case we um, want to switch that off, we can go and switch off. So for the manual type, we'll say does not require. We'll switch off the, if it is already manual. Right now it is enabled, right? See, require journal approval. We can set that off to not require journal approvals. So moment we save it, it will get saved. Now, what we'll do is we'll go to the home page, we'll enter a journal which will involve an intercompany journal. So you have the create journal, journal batch, we can specify the name SP intercompany batch. We can leave the accounting period as it is, and we'll have the name, we'll specify the same name. Journal. journal. Okay, and primary ledger will oh, this is set to the Australia primary ledger. We have defined it for US primary ledger, right? So I need to change it. This is the journal. Okay. Primary ledger, secondary ledger. And then we have the source here. The currency is currency. Then we have the category here. Now, if you remember, our company was 101. So we will have an entry for any other entity and 101. So 101, 10, and let's okay, international revenue, let's say, and rest of it will leave blank. $1,000. Then we'll have the corresponding journal for another company. Now see, earlier I think it was Santosh who asked me about the balancing, right? Now, when we talk about balancing here, let's say any other account that we take, when what we mean by balancing is at the 101 level, so it is balanced in the sense the debit and the credit are equal. The account may be different, but or the cost center may be different, but the company has to be the same. That means for that particular balancing level, the journal is balanced. Got it? That is what we mean by balancing. Now, if you will always be having different accounts, so it can't be balanced at that account. You could have different lines of business. That's also possible, like one line of business giving some information, some resources to another line of business. So between line of business also, the values may be different, but at the company level, they have to balance out. So that is the balancing segment. So here, for now, let's put in another account. Is there anything else?
So any subledger transaction, how will it will get mapped here?
Sorry.
The subledger transactions. Okay, you might have created a subledger for payables or receivables, right?
Hmm.
You may be having a different combination of COS while posting the journal entries, right?
Hmm. Hmm.
So when it comes to the primary ledger, and if there is any difference, how that will be balanced?
Okay. So the balancing here in this particular case, balancing is at the company level.
Okay.
Okay. So whether it is in payables or receivables, behind the scene that accounting entry gets generated with that
Yes.
distribution, correct?
Correct.
So
Correct.
all that accounting entry eventually comes into general ledger.
Correct.
So at that accounting entry level, the liability, expense, or the revenue and the receivables, they have to match. They have to be equal debit and credit.
Yes.
So the company segment in those values, they have to be the same,
Correct.
irrespective of what the debit and the credit accounts may be. So that will ensure that your journals are balanced.
Okay.
Okay, but in this case, in case of intercompany, what we are doing, we are changing the company segment. We are saying that the company is going to do a transaction with some other entity.
Okay.
All right. So
So
I have this
what I
101.
sent from what
Sorry.
I sent from company one should be equal to the what I received from the company two.
Correct. Correct. So that other example you were talking about, Oracle US, Oracle India,
Yes.
two different companies. So if you see here, I have Colombia, Argentina, Chile, Brazil, Canada. So let's say I want to do a transaction between US and Canada. Got it? Now, typically, we will say this is not a balanced journal, isn't it, as per our definition? Because at the company level, you have a 101 and you have a 151. There is no debit for 101 and there is no credit for 151.
Yes.
So they are not balanced. So through intercompany, what we are doing, when we post it, you will find that the corresponding journals are automatically generated.
So this eventually again boils into the subledger also, because if I receive $100,000 from US to
Hmm.
India legal entity, so that how that $100,000 has been distributed across my department should match,
Correct. Correct.
right?
Correct.
So all my subledger should lead to the balancing value also
Correct.
at the company level.
Yes.
Here only at a higher level we make an entry like what we received, what we spent. But if you get
Hmm.
into the detail, it will go to subledger.
Actually, this is just to show you directly that transactions come from there. When system finds a intercompany transaction, it will generate it directly. You don't have
Okay.
to worry about it.
Okay.
See, now we have four entries here. We entered two. The corresponding intercompany balancing line has been generated by the system. Everybody followed this?
Yes.
Yes, sir.
Amit? So this is the purpose behind the intercompany setup. You don't have to worry about the intercompany part, the balancing part of it. So this goes back to our opening journal entry that we saw today. If you remember, we talked about this.
Yes.
So the system will generate the corresponding intercompany transactions. Now let's look at another type of journal. In this case, everything is similar except when we enter the journals here, let's call this intercompany. Last one I had put it as intercompany. Okay. So here, what we'll do is we'll keep everything else remain the same, and the only difference we'll do here is in the account we'll switch the company. So we'll not have the 101 company at all. We'll, let's say, have as 202, and so this is Argentina company and some other company, not 101. Let's take a totally different, something different from another geography. United Kingdom or Sweden. Okay. Oh, I forgot to enter the amounts. So this will be again, let's make this 1500, and so in this particular case, if you see the companies are different, that means the balancing is being done, the sorry, the intercompany accounts have been generated at the ledger level. Ledger is the same. Now, if you look at this IC journal 2, see, in this particular case, the description tells you at what level it has balanced it. It is at the ledger level. Why ledger level? Because our ledger was the same, US primary ledger. But the two entries, the two corresponding companies were different. In the first example, we had one company which was equal to the legal entity 101. In this case, both the companies are different. We are not talking about 101 at all. We are talking about, I think it was Argentina and Sweden, two different entities. But since it is against a particular ledger, the ledger is US primary ledger, system has generated the corresponding intercompany account. So it is ensuring that your entry is getting balanced. And where does it get this account from? It is what you have defined at the rules level. Got it? Now we will see how we enter intercompany journals. So for that, if we go to the home page, we'll find there is a separate offering called as intercompany. This is the intercompany accounting, where you can enter transactions directly which relate to intercompany. Okay, so you have a create company, sorry, create transaction. So you will create the transaction. So you will provide, you will enter the provider information. Okay, so you choose like US2 is your provider. And so we have the batch control, batch name. Okay, all of these are now defaulting. Okay, And on this transactions, so the receiver is your, let's say, US1 intercompany org. So provider is US2 and receiver is US1. It could be the reverse also, depending on how you want it. And we'll say debit of 100. And the transaction distribution. So this is where we'll be putting the accounting information. So we have 101 10 41 000. Which particular account is saved Okay. And So this is the provider. In our case, the provider was US2. Okay, I missed that. I was putting it under US1. So US2 is our provider. So we have the US2 102, and the receiver is our 101, which is the, for that we'll have to put it to the 101 account. Six. Okay. So now the entire thing is done. I just have to re-enter this one more time. So the from that is once again the provider. So let's say we call it US1 Intercompany is our provider. Then transaction intercompany adjustment date can be today's. So this time we are using the US1 intercompany. So the corresponding entry will be the receiver would be US2. So first US2 intercompany org, and debit would be 100 or 1000, whatever we want to put, and provider level will have the 101. So provider in our case is the US intercompany org 1. So 101 will remain, and we can put it as 41000. Okay. And this US2 was debit, so this will be credit. the receiver distribution is 10. So in this particular case, the opposite entry would be passed. In this case, the 102 and okay, and the corresponding debit. Now, once this is done, we'll submit this. So here you are entering the intercompany transactions, and then we will go and review the intercompany transactions. Now we have inbound and outbound. Inbound is what is coming inside. Provider was US1, company or receiver was US2 intercompany. Okay, so this is our transaction. See, the intercompany balancing line has been generated. Similarly, this is for the receiver, and similarly for the provider, you will have the other invoicing line generated, which is the opposite, the debit and the credit. Okay. Any questions?
No, sir.
So basically, what they are generating, what they're doing is they are generating the corresponding balancing entries automatically based on the intercompany transactions that you are dealing with. So the rules are set up, the intercompany rules are set up. So you could have rules between one legal entity and another legal entity, from ledger legal entity to another ledger legal entity. So from to between the different primary, secondary ledgers, you can have your rules set up so that the corresponding debit and credit transactions are automatically generated. Okay. Now let's take a look at how we have some of the rules defined. Once again, this time it will make a little more sense based on our experience so far. So let's say we have the US primary ledger as the from US ledger. So now if you look at the legal entity rules here, you will find, see, these are the different combination of the rules that have been set up. So if you look at this one, this is the rule between US1 legal entity and US2 legal entity. Okay, so you have the receivables account as 18100 and the payables account as 2100. So where we have that provider and the receiver, so this is where the rules are derived. Okay, these wouldn't be applicable because this is from combination of these two. Okay, so that is the logic behind how the system gets generated. Now one more thing that we have to do with that intercompany, coming back to that intercompany transaction. Okay, now you have the ability to transfer to GL. This is from the intercompany set to the general ledger. So in that case, you will say from date, let's say whatever we have done today, that we are going to transfer over. From intercompany org. this is yes. So from this we'll say submit. Now this we are going to move to the general ledger. So for that we'll have to go to the general ledger accounting and review the transaction. This is our 100. Okay. The now see this has got posted. This was our last intercompany transaction, right? Is now posted. This one. These are the IC journals. One journal. I think it's this one. Yeah, this is the one. This is the global intercompany 102 and 101. The corresponding journal lines, $100 each, right? So the journal corresponding journals have been imported. So from the global intercompany set of tables, we have transferred it into our general ledger module. In the global MNCs, you may have the provider organization or the shared service organization, which is totally responsible for dealing with all intercompany batches. So in that case, you would have a team that would be entering the information, and based on the information that they enter, we'll be importing that into general ledger and posting it. Okay. Amit, Rakesh, Santosh.
Yes, sir, I'm getting it.
understand the functionality behind this, right? So
Yes, yeah.
that really is helpful. Otherwise, we tend to get lost in this.
Probably one complete transaction may be beneficial. Like after intercompany transaction, how we move on to the other submodules, where how we utilize the money and how we post back the engine.
You mean from receivables, payables?
Exactly.
Uh, I think, first, if you do this manually, it will help you to understand the process and then we can look at that.
Yes.
So, shall we do a quick recap of what we did? Okay.
Yes.
So, what? Yes. Were you saying anything? All right. So, what did we do? Let me just. So, this is what we did in the intercompany rules. Let me say balancing rules setup. Okay. Then we entered different types of journals. And review. We also created an intercompany balancing rules. Okay. And then creation of intercompany journals. What are the types? One was balancing between 101 and any other company. We did one. We did was one was between US one and any other company. The other one we did was between any two countries. So this was balancing at the balancing at the segment level, balancing at segment level. Next was balancing at ledger level by entering journals between two companies, right? And So we picked up Argentina and Sweden. That is Argentina and Sweden, or any other country that you wish to. So that was our second example that we reviewed. So similarly, you can obviously do it for balancing at the primary balancing segment level also. So the 101 will remain constant. System will automatically generate it for the other if any of the other values are different. So after this, we went in and created a global intercompany batch. From navigator, just to help you recall, from the navigator we had that intercompany. We went in and provided it between from for transaction between provider and receiver organizations, for transaction between provider and receiver organization. Okay. The next step that we did was transfer the global intercompany batch to general ledger, transfer and post. Okay, so this is what we did as far as our intercompany transactions was concerned today, right? Now, one last thing before we close this particular session is about doing any kind of reconciliation that might be required as far as the transactions goes. For that, within intercompany, you have the reconciliation option. Okay, you see this reconciliation tile, you click on it. Okay, so we go into actions, we say run. So which is our provider legal entity? We had US. Okay, we can pick up US. Now these are optional. Okay, or we can directly enter the accounting period. If there are a lot of transactions, then it makes sense to use it only for a particular legal entity or particular ledger. Once it completes, you will see the summary. So it helps you to understand the differences that might have cropped up. If you see here, entered amount, there is no discrepancy. Okay. Now the total legal entity level, provider legal entity, receiver legal entity, this is YTD. In this period, in this particular month of May, we only have 100. Then we have 1000 and we have 1500. So for this period, if you see 100, 1000, 1500, it is tallying with the 100, 1000, 1500 accounts between receivables and the payables accounts. So it's easy for you to do the reconciliation and understand where you stand as far as the intercompany transactions are concerned. Got it? Everyone? Okay.
Yes, sir.
Amit?
Yes, sir.
Okay. Santosh, you good?
Yes, sir.
Okay. So, you know what, in all, what we have seen the setup of the intercompany. We did transactions for intercompany. We did global transactions for intercompany, and then we did the reconciliation for the intercompany transactions. All right. So that is what I had for intercompany. Guys are okay with this, then we'll stop here. So please have a go at it. Try this out. I'll also double check on the yesterday's recording, Santosh, and I saw that in the folder it's not there. So I will follow it up.
Yeah, could you please give some activities, student activities,
Okay.
guide something like that? It will be helpful for us.